Welcome to AI for Beginners Demystified, the podcast that makes artificial intelligence simple, practical, and profitable for small business owners. Each week, we turn complex AI concepts into real-world strategies you can use to grow your business. Hosted by the team at Internet Marketing Services. This is AI for Beginners Demystified, where the future of business starts today. Let's get started.
Welcome to AI for Beginners Demystified, the podcast that makes artificial intelligence simple, practical, and exciting. I'm Rick Samara.
And I'm Paul Stober. If you're scanning the business headlines right now, there's a good chance your anxiety meter is spiking. We are just saturated with warnings about the AI bubble. The feeling is palpable. You've got these massive valuations, just endless hype, and this, creeping suspicion that expectations are completely detached from reality.
It's the dominant tension in the market. Absolutely. And it's why we stack these sources for today. Our mission is to really cut through that noise, to perform a necessary separation.
Separation of what exactly?
We need to detach the market speculation, all the while sometimes unsustainable valuations, from the actual underlying durable technological value of AI itself.
That's the key distinction, isn't it? Because you, the listener, need a thoughtful or responsible approach to AI adoption that doesn't just chase the next short-term market swing. Right. So, okay, let's unpack this core idea right away because it's the anchor for this entire podcast. Market hype, it's volatile. It might fluctuate wildly, but AI's technological fundamentals, they seem remarkably strong.
Think of it this way. The essential takeaway, the thing that has to guide your strategy, is that an AI bubble does not, by definition, equal AI failure.
An AI bubble does not equal AI failure.
Exactly. And if we can understand why one might happen and why the other, almost certainly won't, then you're strategically prepared for pretty much any scenario.
Okay. So let's start by defining terms, this AI bubble shorthand. We hear it thrown around constantly. Is it just about stock prices, or is there something else driving all this financial anxiety?
Well, our sources are telling us it's primarily driven by two, let's call them financial phenomena. First, you have these extremely high valuations for AI-linked companies.
Right. Startups that haven't even made a profit yet.
Not even close. Often before they've demonstrated any consistent scalable revenue. And second, there are the massive and ongoing capital spending cycles.
And this spending is just, it's colossal. It's mostly driven by the infrastructure you need to even do AI, right?
Exactly. We're talking about a full-on infrastructure arms race, the chips, the data centers, the massive power requirements, the cloud capacity. All of it is necessary to train these foundational models.
And that expense is what's fueling a lot of the bubble talk.
It's a huge driver of the current anxiety because, as some of the reports we reviewed from Goldman Sachs and Sequoia Capital have noted, there's just so much upfront spend.
With maybe too little immediate proven productivity gain flowing back to the average company right now.
That's the fear. So if the cost to build a factory is skyrocketing, but the proven output of that factory is still ramping up, the market starts to feel nervous.
Okay. So if this worry turns into reality, what does that look like financially? What happens?
It manifests as a market correction. And, while the simple definition of a correction is usually a 10 to 20% decline in stock prices, the reality in these super volatile tech-heavy markets is it's often more nuanced, more targeted.
What do you mean by that?
A correction might not affect the established tech giants uniformly, but it could just decimate venture capital funding. It could crush the valuations of startups that are just burning through cash with totally untested business model.
That kind of volatility is normal in tech cycles. But I think the key distinction here, and this is what separates smart investment from pure panic, is understanding what is being corrected. Is it the technology or is it the speculation around the technology?
It is entirely about valuations and spending cycles. This is the crucial lesson. Even if every single dire headline about overvaluation is true and the market tanks tomorrow,
Yeah.
that is a reflection of investor sentiment, not the utility of the technology itself. If the AI bubble bursts, it means some business models failed. It does not mean the core math and the algorithms just stopped working.
Is that famous analogy, the sources layout, the dot-com crash versus the internet stopped working?
Yeah.
And we all know the internet absolutely kept on working. Yeah. That analogy, the dot-com era, it feels critical for context here. You really can't understand the current anxiety without understanding that piece of history. So let's set the scene. Late 1990s, tell us about that initial wave of just unadulterated excitement.
Oh, was pure mania. I mean, the internet promised to change everything, and that promise just translated into this unprecedented flood of investment.
Right.
Investors were funding companies based on eyeballs or potential instead of, actual proven profits. You had startups with zero revenue trading at billions in valuation just because they had a .com address.
Yeah. Stock prices were completely untethered from any fundamental business performance.
Completely. It was an amazing time. Psychologically, I think everyone felt they were going to get rich simply by being associated with the internet. But then, of course, the reality check hit somewhere between 2000 and 2002.
The net crash was just brutal.
It wiped out trillions in market value. Yeah. Thousands of businesses folded, many of which had gotten enormous amounts of venture capital. But here is the central historical finding, the thing we absolutely must apply to AI.
What's that?
While the speculative financial ecosystem collapsed, the underlying technology, the network, TCP/IP, and the ability to communicate globally, it did not disappear.
The technology persisted, but the ideas on how to sustainably monetize it, a lot of those failed. I remember companies like pets.com becoming the poster child for failure. Great idea, maybe, but with a completely unsustainable business model.
Quick question for med spa owners. How many calls did you miss this week? Because every unanswered call could be a $500 to $3,000 client booking somewhere else. That's why med spas are turning to Voice AI Plus, an AI-powered receptionist and follow-up system that answers every call 24/7, books appointments, and follows up automatically. No voicemail, no missed opportunities, no extra staff. And it doesn't stop there. Voice AI Plus also includes your CRM, booking calendar, email automation, and review management, all in one system. Try it free for 30 days and see the calls, the bookings, and the ROI for yourself. Visit the link in the description to learn more today.
That's a perfect example, a perfect one. Pets.com failed because its underlying model couldn't handle the real-world complexities of storing and shipping these heavy bags of pet food economically. They were selling the idea of internet commerce without the infrastructure to actually back it up.
So the market started demanding that companies focus on real things, on infrastructure, logistics, actual customer value. That separation is key to understanding who survived.
Absolutely. The companies that endured were the ones that adjusted their models fast and focused on fundamental value delivery. Amazon, for example, it survived because it shifted focus from being just a pure online retailer to building these robust distribution centers and, crucially, developing reliable web infrastructure.
Which later became AWS, a huge part of its business.
A massive part. And Google survived because its core product, search, was fundamentally efficient and monetized through advertising that just plain worked. They emerged stronger because they were forced to be disciplined. Practical, transformative technologies always outlive their initial hype cycles.
The lesson there is clear. Volatility is basically guaranteed, but durability is the hallmark of a truly essential technology. So if the internet survived, what evidence do we have that AI's fundamentals will endure no matter what happens to the stock market next?
Well, the primary evidence is its deep and, I'd say, undeniable integration into essential systems already. We're past the stage where AI is just some futuristic concept.
It's not a what if anymore.
No, it's already functioning as mission-critical infrastructure across the entire global economy. This widespread utility is what guarantees its long-term stability.
We aren't just talking about, playing with ChatGPT. We are talking about processes where if you pulled the AI out, the whole system would immediately degrade or even halt.
Exactly. Our sources cite its deep embedding in sectors like healthcare, where AI is used for advanced medical diagnostics, drug discovery. Surpassing human capabilities and pattern matching.
And finance.
Essential for fraud detection, algorithmic trading. Manufacturing relies on it for predictive maintenance, for supply optimization. AI is just it's baked into the foundational tools we use every single day.
Okay, but let's play devil's advocate for a second. Let's push back on that durability argument. These systems rely on incredibly expensive chips, massive, power-hungry data centers. If the market crashes, capital dries up, and everyone stops buying the infrastructure, doesn't that fundamentally undermine the technology?
That's a crucial question. And it speaks to the distinction between training costs and inference costs.
Okay, break that down.
The current bubble anxiety is driven by the massive cost of training these immense foundational models. That's highly speculative. It's a huge capital expenditure.
Got it. So the market panic is over the cost of building the supercomputer in the first place.
Precisely. But the long-term utility, the actual value, it comes from the much cheaper inference cost. That's the daily running of the smaller specialized AI applications once they're trained.
I see.
That daily utility is what drives an ROI that businesses just cannot afford to lose. The fundamental value of the technology really lies in 4 core strengths, and these guarantee its relevance regardless of market cycles.
Okay, let's move beyond a generic list. Let's really dive into those 4 strengths. How do they translate into indispensable utility?
First is automation. And this is not just about replacing repetitive manual labor. It's about automating complex, high-value decision-making processes.
Like,
for instance, dynamically optimizing routing for a global shipping fleet or managing energy usage in massive data centers. These efficiencies translate directly into huge operational savings that are immediate and measurable.
And the second point, pattern recognition. How is that uniquely valuable?
This is where AI just excels beyond any human capacity. Think about drug discovery, sifting through billions of chemical compounds to find promising candidates, or in financial markets, detecting these minute anomalies that signal sophisticated fraud.
Things a person would just never see.
Never. AI's ability to identify complex patterns in vast data sets provides insights that are simply impossible for human teams to achieve. It makes its application indispensable for both profitability and risk management.
And that inherent ability to process complexity, that's your third strength, right?
Yes, the ability to process complexity is key. Humans are great at intuition, but we're terrible at integrating millions of variables at the same time. AI thrives there.
And the fourth strength?
It's efficiency and driving efficiencies. It's sort of the meta capability. AI doesn't just automate one task, it optimizes entire processes, creating these ripple effects of productivity across an organization.
So even if the market decides a particular AI startup is overvalued by 50%, the underlying need for a hospital to use AI to rapidly analyze medical scans or for a bank to detect fraud, that doesn't just vanish.
It doesn't vanish. Those utilities are now integrated economic necessities.
They do not stop working.
They do not stop working. The intrinsic value of those efficiencies ensures AI will remain a cornerstone of our future technological landscape.
That brings us to the most practical part of our podcast. For the business leader or the operator listening right now, if we accept that AI technology will endure, what should your strategic plan look like? What kind of environment follows a market correction, and how do you make sure you survive that filtering process?
The environment post-correction it's a purification process. The cheap speculative capital that was fueling all these weak business models just dries up. The hype-driven ideas that focused on novelty over substance, they fail fast.
And the strong, adaptable, disciplined models survive, they adjust, and they grow.
Exactly. So the entire operational focus shifts. You're no longer rewarded for having a flashy idea. You're rewarded for delivering measurable results.
Sustainable, practical AI use becomes paramount.
Absolutely. Which means the key for you right now is disciplined implementation focused on quantifiable value, not on market buzz.
Let's break down that disciplined strategy. What specific advice can we offer based on the analysis of these market and historical trends?
Okay, so start small and internal. First, focus relentlessly on operational value and productivity gains. You have to insulate yourself entirely from market speculation.
So what does that look like in practice?
It means if you're implementing AI, start with internal processes that have clear, measurable KPIs. For example, instead of immediately rolling out some costly customer-facing generative AI chatbot,
which everyone seems to be doing,
right? Instead, focus on using AI for internal document summarization, recording assistance, or maybe optimizing your supply chain routing. These provide immediate measurable ROI.
That shifts the focus from look what we can do to look how much money we saved. Okay. What's the second piece of a disciplined implementation?
Continuous monitoring and adjustment. You have to treat AI implementation as an ongoing management process, not a one-off adoption. Monitor the performance of your AI tools rigorously.
And be willing to pull the plug.
Exactly. If a project isn't delivering the operational value you projected, be willing to sunset it or pivot the application quickly. Don't let sunk costs drive bad operational decisions.
And finally, the third strategic component, the one that's often overlooked during the chaos of a boom, which deals with stability.
Yes. Acknowledge and integrate the reality of regulatory frameworks. As the technology matures, governments and international bodies are stepping in to create rules. For example, you have the EU's AI Act, which provides a classification system for risk.
And while that might seem burdensome,
it ultimately stabilizes the technology's future, it reduces ethical chaos, and it builds necessary public trust, ensuring responsible long-term integration. The smartest strategy is practical, disciplined AI adoption, recognizing that innovation continues post-correction, It just continues with clearer boundaries and some necessary fiscal discipline.
This has been a necessary separation of hype and reality. I think our primary conclusion is pretty robust. Market valuation and technological value. They exist on separate planes.
Even if the long predicted AI market correction arrives, the technology itself is not going away. Like the core utilities of the internet back in 2002, AI will continue to function, evolve, and deepen its integration into our economic infrastructure.
So here is a final thought for you to take into your week, building on this historical parallel. If history shows that technologies emerge stronger, more focused, and strictly practical after the market clears the decks, when the focus shifts solely to real business value, not speculative money, you should be asking yourself,
what specific area of my current operation, bottleneck, a costly inefficiency, a critical decision point is ready right now for that kind of practical, focused AI implementation, regardless of all the market noise? Focus on the measurable outcome, and you win, whether the market goes up or down.
So let's bring this home. We started today with a feeling a lot of people have right now, anxiety. Headlines screaming about an AI bubble, massive valuations, and the fear that this whole thing might collapse.
Right. And the core separation we made is the most important idea of the episode. Market hype and market valuations are not the same thing as technological value.
Exactly. An AI bubble does not equal AI failure. Even if there's a market correction, even a painful one, the technology itself doesn't suddenly stop working.
We saw that before. The dot-com crash wiped out trillions in value, but the internet didn't disappear. What disappeared were weak business models that couldn't deliver real value.
And that's the pattern we're seeing again. Corrections don't kill essential technologies. They filter them. They strip away hype and force discipline.
Which brings us to one of the biggest takeaways. AI has already crossed the line from interesting experiment to mission-critical infrastructure.
Healthcare, finance, manufacturing, logistics. If you pulled AI out of those systems today, things would slow down or break immediately.
And that durability comes from its fundamentals: automation, pattern recognition at superhuman scale, efficiency gains, and the ability to process massive complexity.
Another key insight we covered is the cost distinction. The market panic is about training costs, the massive upfront investment, but the real business value comes from inference, the everyday, cheaper application of AI once it's trained.
Which is why businesses won't abandon it, regardless of market cycles. The ROI is too real and too embedded.
So if you're a business leader listening, the big question isn't, will AI survive a correction?
It's, will my strategy survive one?
And that leads to the most practical takeaway of the episode. Post-correction environments reward discipline, not flash.
That means focusing on measurable value, not hype, small internal wins, clear K, PIs, productivity gains you can actually point to.
Which brings us to an action you can take this week.
Here it is. Pick one operational bottleneck, one costly inefficiency, one slow decision point, and ask how AI could improve it today, not someday.
Not a flashy customer-facing demo, not a big speculative bet.
Something boring, internal, measurable.
If it saves time, reduces cost, or improves accuracy, you're winning no matter what the market does next.
Because when hype fades, value remains.
And the companies that focus on value now are the ones that come out stronger on the other side.
Thanks for listening to AI for Beginners Demystified, brought to you by Internet Marketing Services, helping small businesses harness the power of AI to work smarter and grow faster. If you found this episode helpful, don't forget to like this video, subscribe to our channel, and turn on notifications so you never miss a new episode. Be sure to check out the description below for valuable links and resources, including free tools, learning guides, and ways to start applying AI in your business today. And visit eInternetMarketingServices.com to explore even more AI tools, tips, and resources. Until next time, keep learning, keep growing, and keep demystifying AI.